Welcome, guys. This is Trading Topic Tuesdays. This is Hawaii Trading Academy. Glenn and Reid here. The reason for this Trading Topic Tuesdays, we're going to be diving into topics regarding trading, which could be ranging from strategies, takeaways, lessons, experiences. And the point of this is just to help you as a trader develop and gain confidence in your system, in your trading. So tonight is a very key, awesome, important topic, which is risk management. And this, I'm telling you, one of the main pillars of trading, risk management. And this is what separates the great from the average. Okay, so let's dive in. I'm gonna be sharing my screen. Lots of awesome content. So if you're rewatching this, folks, take out a notepad, keep it fresh, and just take notes as you go, as you watch. This is going to be also on the replay on the Mighty Networks for you folks. So this is really good. Let's dive in. Risk management, as you can see, Mr. SpongeBob, he got it. He got the risk management going on. All right. Live to trade another day. Make that your motto. If you already got a bunch of models in life, add that another one. All right. Live to trade another day, because that's going to be that thing that's going to prevent you from blowing up your account that time. Personal experience. So a quote, I found this across on the internet. Anyone who starts down the road to becoming a trader eventually comes across the statistic that 90% of traders fail to make money when trading the stock market. This statistic deems that over time, 80% lose, 10% break even, and 10% make money consistently. Quoted from this website, wealthwithin.com. Bunch of memes. These two memes are classic and aids to exactly what we are going to be talking about tonight. And, I felt both of their pains. How about you, Reid? Like, can you
Oh yeah,
relate to
definitely,
those?
man. Yep. Yep. It's not as easy as they say.
Yes. Yes. Another meme for you folks. For your entertainment purposes only. It's either Lambo or food
Or
stamps.
food stamps.
This is purely a joke. We love to keep it just laid back for you folks. I can't 100% stand by this. I mean, we need to keep it fun.
Yep.
But Lambos are great. Okay, great car. Great car.
Just don't
So the
risk
risk
everything
man.
trying to get it.
Yes,
Yeah.
yes. The risk management introduction. Definition of risk. Let's just define that word, risk. Expose someone or something valued to danger, harm, or loss. So, practically, what we're doing when we are in the markets, we are putting our capital, hard-earned capital, at risk, in order to create a profit. All right, plain and simple. We risk every day when we're driving in our daily commute in traffic, or you're crossing the street. There's some risk to that. There are statistics on accidents. I don't want to bring any negativity, but the things we do in life, eating at a restaurant, food poisonings, I've got to my share of food poisoning. I don't know about you, Reid, but
Yeah,
that's been
definitely.
terrible. I still do love to eat out.
Yeah.
I take the risk every day, right? Risk, a lot of people pair it with fear, because the I think, for me personally, I would bring that two together, is because of the feeling you get after you lose what you were risking. Say you were risking some money in the markets or some money elsewhere, and you were so sure on the bet, you become emotionally married to whatever you were betting on, then you lose it. And so, our brains, this is really interesting. Our brains are wired throughout the evolution of man, all these years. They're it's wired to do a few things well, which is survive, right? And fear is that mechanism that we all have, no matter who you are, right? No matter how rich you are, you will have fear. But some people deal with fear better than others. And some people, while others allow it to control them to a big point. So risk always plays a role in your trading, and you have to allow yourself to trade another day. All right, which is what we're going to be drilling into later in this evening with all the content here. Anything you want to add there, Reid?
Yeah, as far as fear goes, an example of fear in the markets is when you put on a trade and you constantly want to check that trade and you're hoping, wishing that your trade didn't lose. And so when you have that hope and that wishing, you're not trading a plan. So it all goes back to plan. You want to put this risk management into your plan, and that eliminates fear, or at least it limits it to a very minute degree. So that's what we're trying to help you guys is develop your plan and have proper risk management within that plan.
Yes. Yes, we want to clap ourselves because we're able to trade another day, okay?
Yeah.
Oh man.
Kim
So
Dong.
risk, like what Reid was saying, risk happens when you enter a trade. You need to know how much you're willing to risk. Number two, where can you start to reduce your risk slash exposure that can lead to a profit? So these are questions to kind of go over yourself and start assessing for yourself. If you need explanation, feel free to ask us any clarification for sure. We're here. And number three, how to maximize profits while managing risk. These are all key things that, say, after watching this video, you may not be able to answer it clearly, but hopefully the goal is to get you on the right track of thinking, changing your view about risk, right? You have to get to a point where you're going to be comfortable as a trader to be able to, knowing that you're risking money in the markets. Okay. For one, like number one, just to clarify that, knowing how much you want to risk, how much you comfortable losing. You start out with an account. Say you got $1,000. Would it be wise for you to risk $1,000 on the first trade? Yes
Negative.
or no? Right? Negative. So
No.
you wouldn't be sleeping that night. So would it be wise to risk even 500? You know, that's pushing it too. 50%. That's 50%. You got to think about your capital in percentage and start thinking about, okay, cool. If I was to lose $5, $10, $20, I wouldn't be dramatically affected. I wouldn't be fearful. I wouldn't be traumatized from that moment if I were to be wrong. Okay? So you got to start deciding, start getting yourself um, comfortable to think when you're going into a trade what you're risking, because that's when the risk happens. So eventually, right, you'll go from managing your initial risk when you're find your setup, when you have your okay to go in, make an entry, create an order ticket, and then create your initial risk. Here's my entry point, here's my stop loss. I'm good with it. I'm comfortable. I'll be okay if price was to immediately move against me. That is a point. And then as price goes into profit for you, how will you be able to manage it? Right? You have to learn. You're gonna learn from how to set your initial risk and then go on to manage it as a goal. And the risk management directly affects your growth of your capital, right? So, yeah, right there, a small risk equals small losses or gains,
Mm-hmm.
right? Direct correlation. Big risk, bet the house. Big losses are big gains.
But so many people
As you,
only focus on the gains.
yeah, 100%, especially with this crypto stuff going on, man. All they care about is the gains.
Yeah.
No one's talking about, okay, what are you willing to, where are you comfortable losing? And it's painful to see those stories on Reddit or whatever, those forums. People are betting their mortgage and savings, life savings, yeah.
Yeah.
So you are on that picture I put right there, it looks like Jenga blocks. You are the hand. You are the one to control and protect your capital. Your capital is the one standing straight on the right side. Your losses and your losing trades are going to be on the left side. So you have to put that stop. You have to be firm with it, stand your line, and that's going to be something to keep you alive or keep your account alive to trade another day. So scenario one. I put this super cool graphic. So if you're watching on your iPad, iPhone, screenshot this. You're gonna want to revisit this, right? You can also message us to go and send you the PDF if you want. Send you a screenshot of this. Keep on your desktop or print it out or whatever. So it's really, really, this is what risk management looks like in real life. So say you start off with a 10,000. We're gonna go over to scenario one. Start off with a $10,000 account. That's your starting capital. Say out of you, we're gonna talk about 10 trades, and we're gonna risk 5% of capital per trade. Okay, you're gonna risk that, and you're going for a 5% gain if you were to win. And so say your trading strategy has a 40% win rate. So 4 out of the 10 times you will win 6 and then you will lose the other 6 times, okay? Which is a 40% win rate. And you're going to see over the 10 trades what the difference is with your risk management. So trade one, you bet 5%, you risk 5%, which is $500. Say you trade it and you lose, you take the hit. Okay, cool. Your remaining capital is 9,500. Say trade number 2, you got another signal, your entry, go in, risk 5%. Boom, minus 475, and you're down to 9,025. Right? And you just continue that over, right? And now this is how you want to look at your trading. You want to look at it with all the probabilities, all your stats that you know about your particular trading system. So like I said, so you're going to see 6 losses. You're going to have a very a drawdown, a valley drawdown of 73.50, right? Starting from 10,000. That's your very low of your account. And then you're going to come back with your 4 wins back to 8,900, $35. So at the end of the day, out of 10 trades, you have a 10% drawdown of $1,064.92. Here's your new balance after your trade. Yes, you're still surviving. Yes, I'm sure you're probably learning as you're going through those 10 trades, right? You're going to identify, okay, what's working, what's not. This scenario 2, scenario 1 is just really, as you can see, you're risking 5% to make 5%. So it's a 1-to-1 ratio, risk to ratio. All right, we can talk about that a little bit more later, but we just want to introduce that to you. So you risk 1 to gain 1, and you're just going to see that simple math, simple numbers. I'm not strong in math, but I know how to use a calculator. But this is what the bigger picture is when you are approaching the markets, right? And so scenario 2, I mean, Reid, if you want to go over this one.
Yeah, sure, man. So
Okay.
same concept is, except for scenario 2, you're only going to be risking 2% instead of 5%. So you risk your first trade, $10,000 starting, and you lose 2%, that's $200. You're at 9,800, and you keep going. I'm not going to cover every single number because it's there. But now, when you're going to the profits, let's go to trade number 7. You're down at that time. You're down 2, 4, 6, 8, 10, 12%. But you're trading almost a 3 to 1 here. It's 5%. It's really like almost a 2 to 1,
Mm-hmm.
but 2.5 to 1, let's say. And so that's like the profit you want to be going for. And so you're hitting 5% returns back to back to back. And within 4 trades, you're good to go. You're back in the break even. Actually, first 3 trades, so 1, 2, 3, 7, 8,
Yes.
9. You're back to, you're in the green. You're positive. You don't need as many wins when you're keeping control and you're managing your risk at only 2%. You're not fluctuating that risk. You're not increasing your risk as your account lowers. And what I like about this example is, you in real life, in real trading, you're gonna have 1 through 6 losses in a row. Sometimes it'll be 12 losses. I've had months where I had 17 and 16 straight losses in a row, like month after month. And I mean, regardless of strategy and the market conditions, depending on on those things, you will have consecutive losses after consecutive losses. But if you're able to manage risk in a very small and controlled amount, you're going to be back in the green and profit in without that many trades, without 10 to 12 trades. It's just based on probabilities. You could have 16 wins in a row and you'll be up even more, especially with a 2 to 1 at minimum return. It's going to be good for your account and for your psychology. So the main lesson of this scenario is just manage your risks appropriately. Don't over risk and don't risk more when you're down. You don't need that many wins to come back.
Boom. Don't risk more when you're down, dude. That's a nugget.
Yeah.
Write that down. Don't risk
I've
more.
gone I've
Try
done it,
to,
man. I've done it.
what is that? Revenge trading, what we were talking about last week.
Yeah, in a
Revenge
way that
trading,
is revenge trading. Yeah. It may
Right?
not be immediately after. It could be a few days later, but you're like, "Oh, you know what? I lost that the last 2 trades. I'm going to triple my risk now because I need to make back my losses and I know this is going to go beyond it." When you say I know it's going to win, that's when you need to kind of step back, take a breather and be like, "You don't know anything. You just got to play your probabilities. Trade your probabilities. That's it. You don't know anything. No one knows what the market's going to do."
100%
Yeah.
dropping bombs over there, Reed. Dropping bombs. Woo! Yes. Right? Don't double down on your losers. Don't revenge trade because you got to go get it back. All right. Just remember these two scenarios. Um, and this is just theoretically. I mean, there are strategies out there that mimic similar performance. And so this is not totally fictional. This can be a real thing. Okay? And so after 10 trades on scenario 2, you're up 7.6% after 10 trades, which is pretty good. S&P, all the indexes, they track 8% a year annually. So you're almost there at the benchmark. You can call yourself a hedge fund manager after that.
Yeah.
But yeah, so just think about that. Don't worry about the home runs, the 100%, 3,000% gain that you see on the social medias. Okay, they don't show you this, right? They're gonna show you their one lucky, one in a million trade that they got. Hey, all power to them, right? They got luck. They were in at the right time at the right day, and they put the right amount of leverage. So good for them. Okay, but here's a more practical way where you're not gonna get rich quick. You're gonna get rich for sure, and it's gonna take a little bit longer. Okay. So remember that this is going to be a really good piece for you guys to just study and really mimic, almost mimic. All right, start from here. I'm not going to tell you that we're 90% correct on our trades, We're not doing that. No one does that, okay? When people are out there telling you, "Oh yeah, I'm correct 80, 90% of the time." It don't work, man. It don't work. Okay. Last time a hedge fund guy did that, he's in jail.
Really? Wow.
Yeah,
Can you
yeah.
expand a
Bernie
little bit
Madoff.
on that?
Bernie Madoff. He had this arbitrage type of scenario where he said he made money every single month, and he had billions under management, and pieces started to fall off, and his house of cards just tumbled over time, and they caught him. So
Wow.
yeah, very it was a bad scheme. So that's there, guys.
Lesson learned.
Lesson learned. Bernie Madoff. You could do more research. Yeah, this is another chart for you guys to look at. Um, say on the left, it's the percentage of capital you were to lose in your trading, your drawdown versus on the right the percent to recover. So you lose 10%, you're gonna need to hit or gain back 11.11%. I'm not sure on the exact formula they used, but this is kind of a standard that I see other traders use, and their reason for the more gain, the gain required to recoup losses, because I think the like for example 30% and you need 42% is because the volatility and the opportunity missed while you're in a drawdown that has a un what do you call unforeseen loss. You know what I mean? You lost out. You didn't just lose on 30%. You lost out on the opportunity to make more during that drawdown. So here's where you got to be at 42% to come back to where you should be. Okay, this is just
Yeah, that makes sense. I never saw it
yeah.
that way. Yeah.
So like yeah, you go down to 100%, you're broke. Plain and simple. Okay, you don't want to aim here. So just use these to model after. Keep these in mind. It is very hard when you're in a drawdown period. It's very hard. It does a lot, taxing on your mental capital, your physical capital, your trading. You start changes your view, skews your view, because you might have some underlying fear or greed or ego that's uh, going into your trading analysis or the way you look at the market. So, what do you call that? Trading on tilt.
Yeah.
Trading on
Trading with
tilt.
the emotions. Yeah,
Mm-hmm.
so I want to like come back to this graph.
Yeah.
So let's say we had $100 account. We lost
Yeah.
50% of it. That's $50. So in
Mm-hmm.
order, it says percent of gain required to recoup the loss. So first you need 50%, $50 to come back to break even. And then you already
Yes.
lost $50. So now you need to make $50 more. So that AKA equals 100%. I think that's how it's looked at. My bad if
Yes.
you
So,
explained it in a different way.
no, perfect,
Okay.
man. Practical.
Uh,
Yeah, you start off. Yeah, just what you said. So your final balance is gonna be 150. Oh wait, so you had 100 minus
Lost
50,
50. Need
and you. Oh
50.
yeah.
Boom.
You,
That's 50%. So 100%. Yeah, would be one. Yeah, it'd be 150.
150.
Because I guess like what they're going off is like you need to make back all that you lost. So yeah, you got to make back what you lost. Now you got to come back and win that much too. So
Yeah, because don't forget
yeah, it
the
makes sense.
commissions. You gotta pay for that. You gotta pay like the. I think what the unspoken thing is the opportunity missed
Yeah, that makes sense
for
too.
being in a drop down. Because when you're in a drawdown, we're gonna talk about this in more advanced risk management courses. What Reid kind of mentioned was when you're in a drawdown, you don't want to raise your risk higher. You want to keep that drawdown or your risk per trade at the same or even smaller. And so that's something we can work on later
Yep.
down the line. So key takeaways. Key takeaways. Risk management allows you to become profitable over time and grows your account. Keeps you safe from consecutive large losses because those are painful. Anyone can get into a trade, but the difference between great traders and bad traders is risk management. When I started out, I was telling Reid, like, I totally I focus 100% of my time on strategy, being right. Little did I know, okay, what happens when I'm in a trade and it's actually profitable? What the heck do I do, man? I had no clue how to implement any stops or trailing stops, or when to take profit, when to cut my losses. I was averaging down on losses, adding to losers in the hopes of it going back up. So risk management was that piece that I missed for over a year and a half, and which is why we're drilling it right now. We're drilling. I'm sure you had your experience with risk management, Reid, learning about it, right?
Oh yeah, absolutely, man. Absolutely. Like I would just let it run completely for 1%. And I wouldn't, if a trade's running in profit, I wouldn't manage the profit. Like we mentioned, it's one of the three pillars. Like you could get in a trade, okay, good. Now you got to manage it and continue to lower your risk as soon as possible. So the way I like to look at it is like you're looking at your entry, you're looking at the next moment you could go for break even, and then you're looking for profit. Those are like the three parts of risk management, or like the ticks, you know. And we'll cover more about that on how to trade manage, which is it's along the lines of risk management, but trade management is very, very crucial in becoming profitable. But first, we want to just emphasize risk. Don't over risk.
Mm-hmm. Yes, yes. That is one solid piece of the pie or a pillar of your trading that we're gonna continue to talk about, guys, because it's so important. So important, man.
One piece of
Man.
the monopool.
Yes. Yes. Oh man, as we wind down, so that was risk management, the introduction of it. Like I said, you're probably watching it on a replay. Feel free to reach out to us to clarify any of the things we've gone over tonight that we can answer for you guys, and so you guys totally understand it and figure out how to implement it right away. Okay? So, thanks for watching, guys. You guys are awesome.
Well, however,